Hi, welcome to Market in a Minute. So, no college football to talk about. Gosh, there were some really good professional games over the weekend. So, I thought we'd talk about something really neat this week in terms of SpaceX. How do you play these private companies? And we have some really good ideas. The Fed is adding much needed liquidity back into the markets. And there's some big fuel that for the markets to go higher next year. Lots of money in money market funds. You ever play a sport? Like I played tennis and basketball. You ever play those sports? Like I'm hitting the ball really well, and then boom, my strings break. Or, playing basketball where you just have that feel, everything you're shooting goes in, and it's just a beautiful day. Well, I feel like this rotation is happening and it's broadening out the rest of the market. And you know what? I want the ball. This is our type of environment. Not that we've had a bad year. It's been a really good year, by the way. Stock market update. So there's clearly a lack of catalyst in the technology sector. Like we mentioned, why was Nvidia giving their 2 or 3 year, revenue growth expectations? They took the surprise away. Broadcom did the same way. Marvell somewhat the same way. So these companies are telling you what they're going to earn over a 2 or 3 year period. It's kind of taking all the surprise away, unfortunately. So there's a lack of a catalyst right now in the tech sector. Additionally, some of these data centers have been canceled or pulled back, but the rotation is clearly happening and it's coming out of tech, and it's kind of exciting to see. So, what's going on? So, interest rates came down, but it's not enough to really drive those interest sensitive groups in a big way right now. Sure, they can improve, and money's got to go somewhere, and the money may anticipate that happening, but we think kind of right in the middle of the markets. So, not the real high tech companies, um, or the real cyclical companies, but kind of right in the middle is where it'll play out. Maybe healthcare is a perfect example, or the consumer stocks are a really good example. So the spark in the economy will happen probably in the latter part of the first quarter or second quarter next year when everybody's getting their refunds and the withholding is lower and you're seeing some of the benefits from the lower taxes on equipment and et cetera happening next year. So we might see a nice pickup, a really nice pickup in the second quarter. The sentiment maybe got a little bit too negative for technology in the short term. So we're kind of expecting the last couple of weeks, the playbook says the last 2 weeks of December are really, really nicely positive, and maybe the tech sector can come back. But we see in early 2026, they're going to see some profit taking in the tech stocks as people deferred their gains into the new year. If there's a correction, we think it's going to happen fairly quickly. You have all this concentration of positions, like in technology, roughly 48% tech and tech related, and some really big stocks there. So if the correction occurs, there's a lot of margin debt, and these big positions could come down fairly quickly and have a really quick bear market or correction sometime next year. So risk management is really important. As you know, that's kind of what we do. We have good performance, but we also do not like losing money, and we really emphasize the risk management part of that. Looking at the technicals, I think it's key to watch the technicals. You're not going to be able to figure out fundamentally, okay, this is the time I want in or this is the time I want out. So we're watching the S&P very closely. It's at roughly 6830. That's an important support level for the S&P 500. So it's kind of waffling below that a little bit. And then the next area to watch is 6730 on the S&P, which is the 50-day and 100-day moving averages. Now the Nasdaq, it's there, so this is important that it holds. So it's right at a really critical point to 20 and 50-day moving averages. Otherwise, you might see another 3 or 5% downward movement in this pretty quickly. And then the Russell 2000, boy, this has been fun. So this is where the momentum is in the stock market. The Russell 2000 bottomed out in November. We got that buy signal November as it broke back above the 100-day, and it's moved very nicely. So the momentum is in the smaller companies at this point. Important Federal Reserve details. Okay, this is what's going to drive the next phase of the bull market. So look at the reverse repo market. Okay, this is the excess cash in the banking system. Where is it? There isn't any, right? The Federal Reserve kind of, washed it all out with this quantitative tightening. Now they've gone too far. So they're putting roughly $60 billion a month back into T-bills. So this will increase the liquidity some, kind of slow, but it'll increase it some. So what did the Federal Reserve say? So they cut rates by 25 basis points to 375. The dot plots, is where the conversation actually happens, the expectations of all the Federal Reserve members. What they said was one cut in 2026 and another cut in 2027. That's not very inspiring. So the big news out of the meeting was this $60 billion committed to go into buying T-bills. So the inflation rate is expected to come down now in 2026 by 20 basis points, 2.4% in 2026. This is what the Federal Reserve expects. And in 2027 to 2.1. So by their own expectations, the federal funds rate next year could drop under 3%, and then in 2027 could drop down to about 2.5. That would be beautiful for the cyclical side of the stock market. It would perform really well. Housing would come back. So that's really a positive thing. And I don't think the market's really caught on to that yet. It did hear the $60 billion coming into T-bills. And so what they're doing is they're adding 20 plus the amount of money that rolls off the agency debt, $40 billion per month. Well, they're going to put that back into buying T-bills as well. So a total of $60 billion to be buying T-bills. That's roughly 30% of the T-bill market. So rates will come down based on that alone. So it's a nice way of the government to be able to finance their debt is in the shorter term rates, which are lower at this point. So quantitative tightening is, sucked all this money out and it's being reversed. Now we have quantitative easing. They don't want to call it that, but that's what it is. Now Hassett, to me, is a little bit more of a big thinker, economist, smart guy. If he's the next chairman, I think he'll understand how to get the housing market going. So instead of letting all this mortgage debt hit the market and it to be having to be bought by the overall market, just stop it. Just stop letting those roll off, letting all those mortgages roll off into the overall market. So not only do you have to finance the current housing market, but you have to finance all the debt that's rolling off of it. That's what's keeping rates unusually high for mortgages. Bull market fuel. Okay, this is exciting when you look at this graph. So this is over a 5-year period. The money markets have gone, the money in money markets have gone up to almost $8 trillion. So about $3 trillion increase over a 5-year period. That's a lot of excess liquidity. That's roughly 12% of the stock market's value in money market funds. So that's a lot of fuel for the next bull move of this market. And what we're thinking is you get a rotation out of tech a little bit into the other sectors of the market. It can't stay at 48% of the S&P forever. It's going to have to move around. And we've discounted a lot of good news in tech. So as rates come down, you're going to see the economy start to pick up. Other sectors will start to improve in terms of the relative growth versus the technology sector. And some of those technology stocks, they're gonna lack some surprise on the upside, given that the expectations have already been put out there. Now, what bothers us is all this margin debt, $1.1 trillion of margin debt, all-time high. Okay, it is only 2% of the overall stock market value, but it's never all that large of a percentage. And it kind of concerns us because you can see the correlation here as margin debt rolls over. Maybe it's coincidental. So does the stock market. So we're at a high level. The stock market rolls, margin debt comes down, and it fuels that negativity in the overall stock market. And also because all these levered ETFs now, you could have a very big pronounced impact on the downside. Um, so we see really good news in terms of money markets, but don't like the margin debt. But we do see probably the market going higher at some point next year with a big rotation occurring. Now, private securities. Okay, we talked SpaceX potentially going public. Could be a big stock. But, at 800 billion, potential where it comes out at, it's already going to be one of the biggest companies in the stock market. So what's happened over time is that the private equity guys have taken away all that exponential returns that used to be in the public markets. So it's too bad. Other areas picked up that exponential returns, and particularly in the small cap biotech. That's why we look at that space. Small cap biotech, they come public early, and the ones that hit huge. So what happened when I first got into business back in the 80s, Microsoft and Intel went public. Microsoft's been a terrific company. And then later on, Google and Amazon went public. Those were not at enormous valuations. Jeff Bezos had a hard time actually raising money to take his company public. Those companies did really well, and the public markets really benefited from that. Now it's the private equity guys that get the big returns. So if you want to invest in privates, you need about probably $5 million to invest in a private equity fund, and then you're stuck for 10 years. You have no liquidity. So an individual investor has a really hard time. So the overall consensus is they want to open this up now to the smaller investor. And there is a close-end fund, WXYZ. It's called Destiny Tech 100. I would not buy this, okay? So wait for the next one. And we have our eyes on the next one. So Destiny 100, at one point it was 100. Late last year it was $70. This went public, if I remember right, around 10. Okay, the NAV currently is $11 and roughly 37 cents. So it's currently roughly $35 a share. So it trades at a huge premium to its NAV. It has a big position in SpaceX. However, if you increase the valuation of SpaceX from 400 billion to 800 billion, where it's going to go public, the NAV is probably around $14 a share. That's not real exciting. So we have our eyes on another investment that we hope is coming, in a reasonable period of time, a new fund run by probably better investors focused on large cap tech. We're hoping this thing comes around. And so large cap tech, the best tech companies in the world. And so hopefully this comes about. It won't be a big fund, but it'll be really interesting. So if you want to invest in private companies, get that big return. This is potentially a way of doing it. So if you have any questions, you always come to my website, Patrick Adams, CFA, sign up for a hard copy of Market in a Minute, and come to my website, my company's website, PVG Asset Management. And we've really had a good year. We're just trying to close out the year, and we're doing a lot of work on some really good ideas for next year. And over time, we'll let everybody know what we're looking at. Take care.